We have to understand purpose of using Greeks for options trading. What do Greeks do? Greeks allow us to measure how different parameters affect option prices. And these parameters are movement in underlying, passage of time, changes in volatility, and changes in interest rate. These affect the price of an option. And with option Greeks, we can know how these values will change exactly. We know when price of underlying changes, option prices also change. With increase in price of underlying, option premium in terms of intrinsic value increases for in the money calls, and there is increase in extrinsic value for at the money and out of the money calls. At the money calls become in the money call when underlying moves above strike price, and out of the money options come closer to at the money strike. As at the money options have higher extrinsic value, premiums in these options increase due to increase in extrinsic value. There is no intrinsic value for out of the money options. On the other hand, premium of put options decreases when prices of underlying increase. Reverse is also true for down movement. Put premiums increase with underlying coming down and call premiums decrease. As time passes, there is decrease in option premium, and with less time to expiry, more decay in time value is seen. In last session, we have seen how volatility affects prices of options to a large extent. With increase in volatility, premiums in puts as well as calls increases. With decreased volatility, premiums decrease. Interest rate has least effect because usually it does not change, or even if it changes, it is very minor change. Greeks will tell us how these factors affect option premiums. Different factors have their own associated Greek. Out of many parameters, these are main parameters affecting option prices. One is movement in underlying, another is time to expiry, then volatility. These three are very important parameters. Option Greeks give us better and deeper understanding of how options behave, how their prices fluctuate, and if we understand behavior properly, our life gets easier. And how can we get value of Greeks and value of implied volatility? Can anyone tell? There are mathematical formulas which can be used. Most commonly used formula is Black-Scholes formula. Black-Scholes formula accepts parameters like risk-free interest rate, movement in underlying, time to expiry, whether it is call or put, and gives us values of option Greeks. We do not need to understand how this formula works. We need to understand how these Greeks work. There were 3 guys who created Black-Scholes formula, and they got a Nobel Prize for this formula. And we can use their Nobel findings for our advantage. Greeks are used for fine-tuning of constructed trade positions. And why fine-tuning? So that we can have smart trades instead of novice like random trades. These are commonly used option Greeks: delta, theta, gamma, rho, and vega. Delta, theta, and vega are most important out of these 5. Gamma has some effect, but it is covered by delta, and rho is least important. What is delta? Delta is a Greek which governs how option prices will get affected by change in underlying price. We want to know if we expect 300 points move in underlying, how much will be increase in price of an option. It is always better to know this if we have fixed targets beforehand. We can calculate it by using delta. With help of delta, we can find out new value of an option with change in price of underlying. How much is the change in option premium from current premium with change in underlying price movement? This can be calculated using delta. What is theta? Theta is a Greek which governs how option price will get affected by change in time to expiry. It tells us how much will be reduction in price of option after 1 day. Theta tells us how much will be reduction in option price. It will never increase option price in any manner. All other Greeks can increase or decrease option prices, but theta never increases option prices. With passage of 1 day, price always reduces. Options are vesting assets and they lose value over time. This I had covered in introductory session, if you remember. Theta tells us how much it would get vested with time. It includes working as well as non-working days. Now let's come to Vega. Vega is most important factor, and Vega tells us impact of implied volatility change. What is implied volatility? It is current sentiment of crowd, and with change in crowd sentiment, Vega changes. Implied volatility changes. If crowd is greedy, they are willing to pay larger premiums for calls. If crowd is fearful, they are willing to pay larger premiums to buy puts. So these three are most important Greeks and we must understand them thoroughly. Then what is gamma? Gamma tells us about rate of change of delta. Means it tells us how much will be increase in delta or how much will be decrease in delta. Delta is not constant for one strike. If price changes and goes away from the strike price, delta also changes. And this rate of change of delta is given by gamma. Gamma is very minor factor though, and it is covered in delta. Rho is also another option Greek. It tells us how option premiums will change with change in interest rate. But interest rates do not change very frequently, and one need not worry about effect of rho. Its values are also not given on many platforms. I never check value of rho. I guess nobody trades based on effect of rho. Have you all understood this much? Any questions about this? Now let's go in details of delta. What does delta tell us? Delta is a Greek god of price change. It measures the change in options premium for every 1 point change in price of underlying asset. So if underlying goes up by 1 point, delta will show how much increase will be seen in value of call option. Or if underlying goes down by 1 point, how much will be increase in value of put options. And this change is governed by delta value. So delta gives us how much increase will be seen in value of option. Now let's understand how we can interpret delta. Delta changes as the underlying moves. Delta represents percentage participation in the underlying movement. What is meaning of this percentage participation? That means if delta is 0.5, then favorable move of 1 point will give 0.5 point up move in option price. Whereas if underlying moves opposite to option position with 0.5 delta, there will be 0.5 points down move in option with every 1 point move in underlying. When option delta is 0.6, with 1 point move in underlying, option price will change by 0.6. With 0.4 delta, for every 1 point move in underlying, there will be 0.4 point move in option price. When position is long in options, net delta increases when underlying moves in direction anticipated. This creates effect of holding more shares than at the beginning. At the start, if delta was 0.5 and favorable move comes, then it will be 0.6 and 0.7. It will go on increasing. So initially participation was 50%, then it increased to 60%, then 70%. This way, when delta increases, there is effect of holding more shares than at the beginning. When underlying moves against the trader, net delta decreases. What does that mean? If at the start delta was 0.5 and there is move in opposite direction, then delta will become smaller. It will go to 0.4, 0.35, 0.3. That means initially price was decreasing at the rate of 0.5 per point. Later on it will decrease at lesser rate, 0.4, 0.35, 0.3 times. That means percentage participation will decrease when move is opposite. This creates effect of holding less shares while in loss. When move is favorable, there is effect of holding more quantity gradually. When move is opposite to anticipated move, then effect is holding less number of shares than initial investment. This phenomenon creates dynamic leverage. Do you remember in the introduction I had said that options provide dynamic leverage? So this is how it provides dynamic leverage. When move is favorable, it gives higher profit as it goes on increasing, and losses decrease when move is in opposite direction. Then delta can also be seen as an approximate measure of probability for the option to expire in the money based on current market condition. Means if some option has delta of 0.5, then there is 50% chance that it will expire in the money. When delta is 0.6, then there is 60% chance that it will expire in the money. Chance will be 60%. But this is not always true, and this should not be considered as very important rule. It is approximate measure, not a fixed measure of probability. Now let us go deep in delta for calls. Delta for calls and delta for puts is different. How is call correlated with underlying? What is relationship of calls to underlying? Can anyone tell? Calls are positively correlated with underlying. That means when price of underlying increases, price of calls also increases. As the price of underlying falls, premium of calls fall along with it. We have seen this in properties of options in introduction session. As calls are positively correlated with underlying, they have positive deltas. Calls have delta ranging from 0 to +1. Far out of the money options have deltas which are closer to 0. How is call correlated to underlying? What is relationship of calls to underlying? Can anyone tell? Calls are positively correlated with underlying. That means when price of underlying increases, price of calls also increases. and as the price of underlying falls, premium of calls fall along with it. We have seen this in properties of options in introduction session. As calls are positively correlated with underlying, they have positive deltas. Calls have delta ranging from 0 to +1. Far out of the money options have deltas closer to 0. At the money calls have deltas approximately 0.5, that is plus 0.5. Whereas deep in the money options have deltas which are approaching to +1 and they are equivalent to futures. These are standard delta values for call options. Delta can never be more than +1 for calls and it cannot fall below 0. At the money options are in center of option chain, that's why their delta is roughly 0.5. Once again I will repeat, deep in the money call options have delta of +1. Far out of the money options have delta near to 0. And at the money options have delta of plus 0.5. Any doubt in this about out of the money options, in the money, at the money strikes, their deltas? Delta change with expiry. Now please pay attention here. For all in the money options, at the time of expiry, delta is +1 in the money options. Okay, what does this mean? Suppose today I am checking premiums for next weekly expiry for in the money options close to at the money strikes. Then they will have time value as well as intrinsic value. Intrinsic value is difference of spot and strike when options are in the money. So time value will include theta value as well as volatility value apart from intrinsic value. But at expiry there is 0 time value. Extrinsic value of options is 0 at the time of expiry. Whatever value we have is just intrinsic value. It will change with spot as spot value changes, and delta will be +1 for in the money call option at expiry. Let me tell you this with an example for better clarity. Suppose I have bought 35,000 call of Bank Nifty at 2 p.m. on weekly expiry day when spot price is at 34,900. Which strike will I hold? In the money, at the money, or out of the money? It will be out of the money strike by 100 points. At this time, there will be 0 intrinsic value in this option, and all value it will have will be extrinsic value. Delta may be small, around +0.2 to +0.3, maybe in this range, as it is about to expire in few hours. Then gradually Bank Nifty rises slowly to 35,000 by 3:30 p.m. Now at this point it is at the money, but option has expired. There is no intrinsic value and 35,000 call will be worthless and delta will be 0. But suppose expiry is at 35,050, then option premium will be 50. For expiry at 35,100, option premium will be 100. This way, at the time of expiry, delta for in the money option is +1 for calls. Is this clear? Now let's come to puts. How is put correlated with underlying? Puts are negatively correlated. Calls are positively correlated with underlying and puts are negatively correlated. So here everything reverses. When price of underlying increases, price of put decreases. As the price of underlying falls, premiums of put increase along with it. As puts are negatively correlated with underlying, they have negative deltas. Puts have delta ranging from 0 to -1. Far out of the money options have deltas closer to 0. At the money, puts have deltas approximately -0.5, whereas deep in the money have deltas approaching to -1, and they are equivalent to futures. Negative sign is just because of negative correlation. Puts long means we expect down move. So if downward move comes, put premiums will increase. Do not get confused just because of negative sign. So these are standard delta values for put options, and deltas can never be below -1 for puts, and it cannot go above 0. At the money options are in center of option chain. That's why their delta is roughly -0.5. Once again I will repeat. Deep in the money put options have delta of -1. Far out of the money put options have delta near to 0, and at the money options have delta of -0.5. This means if scrip is giving negative returns from strike price, negative delta when multiplied with negative returns will give positive profits. Let us see profit or loss calculation of delta. Net effect of option price due to delta is price at the time of closing position minus price at the time of taking position multiplied by delta. When closing price is less, we can see premium of call for 37,000 is 223 and delta is 0.529. Then price at the time of initiation of position, then this difference will be negative, and for calls delta is positive. So multiplication of negative price and positive delta will give negative result. That means when closing price is below than original price, then calls will be in loss. But puts have negative delta. When closing price is below, then negative returns in underlying multiplied by negative delta will make it positive. So it will be profitable position for put option long. These are rough calculations for at the money calls. Delta of at the money calls is plus 0.5. So if price moves from 17,000 at time of call buying to 17,200 at the time of closing, what will happen? There is net change in price of plus 200, and option price change will be net change into delta. That will be 200 into 0.5, means increase of 100 points. This is very rough, not exact calculation, and you should not use these calculations. I will tell you how to calculate them. These are rough calculations. Now let us see rough calculations for at the money puts. Delta of at the money put is minus 0.5, and price moves from 17,000 at the time of put buying to 16,800 at the time of closing. Net change in price is minus 200. So option price change will be net change into delta. That will be minus 200 multiplied by minus 0.5, which is plus 100. Is this clear? Calculations clear? Now let's move ahead. There is something called as hard delta versus soft delta. What are they? Let us see. While trading scripts, we speak of shares to define position size. When describing an options position, we speak of net deltas, that we are long or short. So when we buy an underlying, what happens? As underlying moves, our profit or loss changes with same proportion. If underlying changes by 10 points, our position profit or loss changes by 10 point multiplier to position size. Which means if we have 10 shares, there is change of 100 rupees, and if we have 1000 shares, there is change of 10,000 rupees. This change is same in both directions. If we have bought underlying, then with increase in price of underlying by 10 points, our profit increases by 10 point multiplier. If underlying goes down by 10 points, our position shows loss of 10 point multiplier. It is reflected 100% in our account. This is hard delta. This is 100% matching with underlying. Hard deltas are fixed. For long share, delta is +1. For short share, delta is -1. Now let us see soft delta. As we discussed earlier, calls have positive deltas from 0 to +1 because calls are positively correlated. Puts have negative deltas from 0 to -1 because puts are negatively correlated. These deltas are flexible and not fixed. For this reason, they are called soft deltas. They are like rubber band or elastic. So when underlying moves by 1 point, calls at different strikes move slightly different to each other. This is due to different deltas at different strikes. For example, if Bank Nifty is at 36,000, 36,000 call will be at the money call. How much is delta for at the money calls? Delta of 36,000 call is 0.5 and delta of 36,100 call is 0.44. These figures I have taken at the end of day for at the money option in option chain, and they remain in similar range. For 10 point move in Bank Nifty, 36,000 call price will change by 5 points, and for 36,100 call price will change by 4.4. Now Bank Nifty has moved from 36,000 to 36,010 with 10 points up move in underlying. At the money calls has increased by delta multiplier of 0.5 points and increased by 5 rupees. With 10 point move, it is increased by 5 rupees. With this change in underlying, now delta will also change. And how much delta change with 10 points move? Any idea? It changes by value of gamma. Whatever is value of gamma, delta will change as per gamma. Delta of 36,000 is 0.5 and 36,100 is 0.44. 35,900 call as delta of 0.56. Means for 100 points, delta is changing by 0.06 paisa. For 10 points, delta will change by 0.006 paisa. And for 1 point, delta will change by 0.0006 paisa. This means when Bank Nifty has increased with rise of 10 points in underlying, its delta will also increase by 0.006 paisa. Means from 0.5 delta, it will now be 0.506 delta. With 100 point move, it will touch 0.56 delta or 0.44 delta if it goes down. What is use of this hard delta and soft delta? This is useful in determining options quantity while hedging portfolio in times of volatility, and they are used as hedge ratio. Now check this part of option chain. Here we have Greeks for Bank Nifty. This is at the end of day post market status. We can see 37,000 call has a premium of 223. And there is delta of 0.529. Now if there is no change in other things but just price changes from 37,000 to 37,100, how much will be value of 37,000 call? And if it comes down by 100 points to 36,900, how much will be value of 37,000 call? Can anyone tell? With 100 points up move in Bank Nifty with delta of 0.529, call premium will increase by 52.9 points and it will be 223 plus 52.9. That means 275.9 approximately. Premiums of 36,900 call will be similar. It is 272. If there is down move by 100 points, call price will reduce by 52.9 points. Means it will be 223 minus 52.9. It will be around 170. Check premium of 37,100 call. It is around 180. Is this clear? Similar is case for puts, but it is reverse. Check this part of option chain. We can see 37,000 puts. This is strike of 37,000. We are checking puts. For 37,000 put, premium is 314.9 and delta for 37,000 put is 0.471. Now if there is no change in other things but just price changes from 37,000 to 37,100, what will be value of 37,000 put? And if it comes down to 36,900, what will be new premium of 37,000 put? Can anyone tell? With 100 points up move in Bank Nifty with delta of 0.471, put premium will decrease by 47.1 points and it will be 314 minus 47.1, which is approximately 267. Here we can check puts premium. It is around 264.95 for 36,900 strike. If there is down move by 100 points, put premium will increase by 47.1, means it will be 314 plus 47, which will be around 361. Here we can see that it is 373. Now let us see in brief how to use delta for hedging purpose. Suppose a trader has 500 shares of Reliance. This means he is long 500 hard deltas, that is plus 500 delta. Contract size of Reliance is 250 shares. Here, if someone wants to hedge Reliance shares, considering there is possible big down move, what is best method to hedge without worry of exiting the stocks from portfolio? Best way of hedging would be buying a put option, right? Question here is, which put option will be best suited to hedge the position completely? How much should be quantity of puts to provide adequate cover of 100%? Here one needs to match delta of puts with delta of underlying for 100% cover. We are 500 delta positive with shares because we are having 500 shares. Lot size of Reliance is 250. So what will we do? We'll buy 3 lots of puts at 2440 strike with delta of 0.67. To completely hedge, suppose current market price of Reliance is 2400. To completely hedge, we need to buy 3 lots of puts with delta around 0.67 to match delta of 500 shares. Lot size is 250. So how to calculate how many number of lots we need? We have to calculate delta, and actual delta for this position will be put delta multiplied by contract size multiplied by number of contracts. This comes to around 502. So this will be exactly matching delta of 500 shares and position will be completely hedged. Of course, if there is down move, delta of puts will increase and it will give better than 500 delta cover. As underlying falls, there will be increase in delta puts. Once there is adequate protection provided by just 2 lots of puts, one should exit 1 lot of put and hold 2 lots to hedge. One can hold on to these puts till underlying reaches buying area, or we decide to exit shares due to change in trend. Hedging is for purpose of capital protection. There is very low profit potential in hedged positions, but capital is protected. Normally what do people do? They buy 2 lots of 250 contract size to hedge 500 quantity of shares. But this will hedge partially, it is not complete hedging. There are many aspects of hedging a portfolio, but I have not learnt hedging portfolio in details, so please excuse me on this topic. Now let's discuss dynamic leverage. Delta gives favorable results with dynamic leverage for option buyer, but it is dangerous for option seller. How? See this option chain. For strike of 760, delta is 0.5. That means participation percentage is 50%. With 10 points move in underlying, suppose we have bought calls, what will happen? When underlying goes in our direction and our at the money call becomes in the money call, what happens at this time? With 10 point up move, delta increases from 0.5 to 0.6158. That means there is increase of delta by 0.11. Initially participation was 50%, now it is 61%. If there is further move by 10 points, then what happens? It will be deeper in the money and delta will increase to 71.59. It will increase to 0.8 with further up move and participation will be by 80%. So when price is coming in our direction, our strike is moving in the money, prices are increasing and delta is also increasing from 0.5 to 0.6, 0.7, 0.8. So in profits, our participation is increasing gradually. But what will happen when there is opposite move? With opposite move means we have bought 760 call at the money call and prices are falling. What will happen to this option? It will become out of the money option. These are out of the money options, these are in the money options. So it will become out of the money option. With fall in underlying, there will be decrease in delta. Delta from 0.5 will go down to 0.4, 0.3, 0.2. What does this mean? Initially suppose we were losing at 0.5 or 50% rate of shareholding. Later on we will have effect of losing only 40% position and then we will have effect of losing only 30% position. So suppose we are holding futures, what will happen? There will be increase of 100% every time and decrease of 100% every time. But with options what will happen? There will be increase by 50%, then 60%, then 70%, then 80%. But when fall is there, we'll be losing with 50%, then we'll lose at rate of 40%, at 30%, at 20%. So with fall, our losing rate decreases, but with profits, our winning rate or profit participation increases. This is dynamic leverage. So delta gives favorable results with dynamic leverage for option buyers, because as position moves in favor, delta keeps on increasing rapidly and option prices increase very rapidly. But when there is opposite move, delta moves slowly in opposite direction. option prices decrease slowly, and because of that losses are low. But what happens to option seller? When there is move in opposite direction, they start losing at faster rates. This is very important to understand. When move is in opposite direction, they start losing at faster rates, especially when options are at the money or in the money. But when options are out of the money, their losing speed will be slow. But when it starts coming to at the money and in the money, losing rate increases. This is very important property one must understand and keep in mind for strategy deployment. Is everything clear about delta now? Any questions related to delta? Please go ahead.